चलिए जी, all right. Right. Chलिए जी, all right. Having discussed the pre-med content and having discussed the preamble for the second part of the course, that is portfolio management, we in this session are going to talk about the portfolio management and the associated topics that have been covered in the later part of the course, which are the post-midterm content as well. Now, this is going to be a summary of our post-midterm content. और इसमें हम लोग कवर करेंगे स्पेसिफिकली कि हमने रिटर्न के बाद इंडिविजुअल इन्वेस्टमेंट से जब शिफ्ट किया तो कलेक्टिव इन्वेस्टमेंट्स कैसे ट्रीट की जाती हैं, उनके ऊपर थ्योरी क्या कहती है, उनकी assumptions क्या थी और उसमें mathematical and statistical calculations क्या थे. So in this particular part we are going to summarize the post midterm course. यहाँ पे हम क्या move कर रहे हैं from individual investment to portfolio of investments. All right, let's start. So the course had the title, the investment analysis and the portfolio management. In the very first part, we talked about individual investments and the valuation of individual investments. Whereas in the second part, it's going to be discussion on portfolio management. Having identified the concept of diversification, we have already gone through this concept that never put all the eggs in a single basket, rather invest your money in multiple alternative investments. Using the concept of diversification and under certain assumptions, Harry Markowitz in 1952 came up with the concept of Markowitz portfolio theory, that is collective investments, ensuring the diversification of your risks. Harry Markowitz in 1952 presented what we know as the Markowitz portfolio theory. Now, even before Harry Markowitz, people were working on the concept of diversification, creation of portfolios. So, what was Markowitz's contribution? Markowitz came up with the statistical and mathematical formula to compute the combined risk of a portfolio, enabling individual investments and portfolio managers to gauge their performances on a commonized scale. According to Harry Markowitz, with certain assumptions, which we had discussed in the class, which are 5 main assumptions, Harry Markowitz presented the Markowitz portfolio theory for a 2-asset portfolio. If I can write down the formula, because for the portfolio to exist, there should be minimum 2 investments. So, using the 2 assets in a portfolio, the return of the portfolio as identified by Markowitz was itself a function of 2 things: the weight of the individual investments and the individual expected risk of the investments. In the form of formula for a 2-asset, it was weight of the first multiplied by the expected return of the first plus weight of the second asset into expected return of the second asset. For computation of the risk of the portfolio, we are making combined investment from a portfolio. The risk of the portfolio identified by Markowitz was a function of 3 factors: the individual weights of the assets in the portfolio, the individual risk of the individual assets in the portfolio, and an important factor that was correlation between the assets that are included in the portfolio. For a 2-asset portfolio, if I write it down as a formula, the risk of the portfolio was the weight of the first asset, square of it, the standard deviation of the first square, that is variance then, the weight of the second asset per square, and the variance of the second asset, plus 2 into weight of 1 into weight of 2 into standard deviation 1 into standard deviation 2, and very important, the correlation between the two assets and under root of this entire equation. So this was the principal formula which was presented by Markowitz, enabling us to calculate the risk of the portfolio. And we identified that this particular value of correlation, it is between -1 and +1. So ideally, according to Markowitz, the correlation between two assets that are selected for inclusion in the portfolio, they should be perfectly negatively correlated with each other. If they are perfectly negatively correlated, that is a good. If they are not perfectly negatively correlated, then if they are negatively correlated, that is also acceptable. But if it is zero correlation, that is also somewhat acceptable. But if it is a positive correlation, ultimately it is going to increase the risk in the portfolio. So in order to ensure that the risk of the overall investment in the portfolio is decreasing, we should ensure that assets that we include in the portfolio should be negatively associated with each other. So basically, we understood this particular concept. Since the return and the risk was dependent upon several factors, we utilized this certain data and we were able to graphically present certain concepts. On the y-axis, we had return of the portfolio, and on the x-axis, we had the risk of the portfolio. And making certain assumptions using certain data, we were able to develop a particular graph reflecting the association between the assets, asset 1 and 2, let's say, if it was positively correlated, and what would be the effect if it was perfectly negatively correlated. We observed that the return did not change because return of the portfolio is not dependent upon the correlation, but the risk of the portfolio is dependent upon the correlation. So if it was positively correlated, this was the return, but the risk level was higher. So if we included those assets in the portfolio where it was perfectly negatively correlated, the risk was reduced, but the return was the same. Where we talked about the certain assumption that for a given level of return, investors will prefer lesser risk to higher risk. And in case of a given risk level, investors will prefer higher return to lower return. Keeping all these calculations in mind and all the graphical presentations, we made these calculations for a positive +1 correlation. We made these calculations for a positive 0.5. We made these calculations for zero correlation and -0.5. And then this was the perfect negative correlation. So we had this particular graph prepared in our discussion. In addition to all this, we also talked about the change of the weights. When we change the weights for a given correlation aspect, we have different points on these curves. We assume different weightages, 80%, 20%, 60, 40, 50, 50, and we change the weights. So all these points for a given correlation existed on these particular curves. And again, based upon the same computation, that for a given level of risk, you will prefer higher return to lower return, and for a given level of return, you will prefer the company which will be the portfolio, which is basically offering lesser risk, enabling us to identify what we refer to as the efficient frontier. Because all the points which were principally placed on the highest point and the leftmost point, they were the optimal points. If you compare point A to point B, obviously point A was better. Simply, if you compare C and D, obviously C was better. So all the points which were residing on the highest frontier, these were actually referred to as the points of the efficient frontier. and we called these as the Markowitz efficient frontier points, which identify the best investment alternatives in the market. So, using combination of two securities, we got this. Simply, if we extended our discussion on this particular portfolio, we identified that there were several market portfolios that existed, and using the data from the portfolios, we could make the market efficient frontier, enabling us the identification of the best ones. Further, we utilized the concept of utility curves, and we identified that investors tend to maximize one period utility. That was one of the assumptions as well. So individuals will try to go to a higher utility curve. They are getting the same utility on this particular curve from this point or this point, but they can increase their utility satisfaction by investing in U2 rather than U1, so they will move towards this point. But U3 was not achievable because there was no such combination of assets or a portfolio that would maximize his satisfaction to increase. And the best point, according to Markowitz, existed at this point where investors could maximize utility, and no point beyond this particular point existed according to Markowitz. Now, that was basically the Markowitz portfolio theory. But later on, there were some contributions by William Shaw in 1964. Developing the concepts of what on the concept that were presented by Markowitz, William Shaw in 1964 presented what is known to us as the capital asset pricing theory or pricing model known as the Keppel model. And according to the Keppel model, according to William Shaw, whatever Markowitz stated, it was all correct. Yet, he identified one small loop in the Markowitz proceedings. He said that Markowitz did everything right, but ignored one critical asset that existed in our system, and that was the concept of the risk-free asset in our portfolio. So when he gave the concept of the risk-free asset and asked the individuals to include this particular asset in the portfolio, now the portfolio consisted of one risky asset and a risk-free asset in the portfolio. By doing this, the return of the portfolio was weight of the risk-free asset into the risk-free return plus 1 minus the weight of the risk-free asset, because all of the investments are being made in the risky investments, into the risky investments. Now, if you invest 50% of your investment in the risky asset, so your return would be 50% of RFR plus 50% of the risky assets return. As far as the risk is concerned, what was the benefit of including the risk-free asset? That was reflected in the return of the portfolio and the risk of the portfolio formula, where the risk of the portfolio was weight of the risk-free asset square into risk of the risk-free asset square, as per the formula. We do it right now like this. And 1 minus the weight of the risk-free asset square into risk of the risky asset square plus 2 weight of the risk-free asset into 1 minus the weight of the risk-free asset into standard deviation of the risk-free asset into standard deviation of the risky asset into correlation between the risk-free asset and the risky asset, and under the entire formula. Now, using this, when we identified that, when we are repeatedly saying that this is a risk-free asset, this is a risk-free asset, it meant that the risk-free asset had a risk of 0. So it is risk-free, enabling us to wipe out this and this concept, since there was risk-free asset. So it is 0, it is going to make the equation simplified. And what are we left with? We are left with only, even the square root is cancelled out, and we are left with half of the risk of the risky asset, which means that we are even able to reduce the risk by half of what we were facing in the risky asset portfolio, enabling us to develop another equation and graphical representation. This was the efficient frontier where all efficient investments existed according to Markowitz, and we called this as the Markowitz efficient portfolio, efficient frontier. This particular concept of the risk-free asset enabled us to achieve points even beyond the efficient frontier. And when we combined it by differentiating different weights, we were able to achieve points, ultimately achieving a point which was basically a tangent between the efficient frontier and the risk-free rate. So all the points that now lie on this particular point, they are reflecting the most efficient points, enabling the investors to achieve a utility level which they were achieving as U2 previously. Now they can go to U3. So U3 is greater utility than U2, which is greater than U1. So principally, the contribution of William Sharp earned him a Nobel Prize because he was able to identify even higher satisfaction level for the investors, even beyond the efficient investor, coming up with the concept of what we know as the risk-free asset. Now, all this working enabled them to come up with an equation known as the Kaplan equation, where the expected return on any investment is now equal to the risk-free rate. Whenever we are going to make investment, we are going to get the risk-free rate. And there is going to be beta, this slope. That is basically very important, which is going to define the systematic risk of the investment into RM minus R. This was the principal equation that was reduced by William Sharp, known as the Kaplan equation. And this line between the risk-free rate and the efficient frontier tendency was later known as the capital market line. The three mid-content, we talked about the security market line, that was one particular security's risk and return relationship, whereas CNL basically identifies the market's basically combination of its risk and return. Now, based upon these, we had certain numerical computations. I gave certain questions on the board and in the book as well. Obviously, you have practiced them, enabling us to compute the beta and the expected return and the vice versa calculation. Everything was basically done as far as the numerics is concerned. Now, according to William Sharp, the return depended on the market premium, where Rn minus Rf was the market premium, and the sensitivity of the company was being measured by the beta, where beta itself was a covariance of the company with the market over variance of the market, which is 1 unit change in the market results in how much change in the company's returns. We identified beta being greater than 1, being equivalent to 1, or being less than 1. There were different basically scenarios for that. When beta goes beyond 1, it is riskier than market. When it is equivalent to 1, it is equivalent to market risk. When it is less than 1, it is less than market risk principle. Based upon the concepts of a single factor that was developed by William Sharp, Ross in 1976 presented what is known as the multi-factor asset pricing model. Or also known as arbitrage pricing theory, known as APD. Obviously, certain assumptions were for Markowitz portfolio theory, 5 to be exact, 8 assumptions for the capper, and there were 3 assumptions for the arbitrage pricing theory. According to the arbitrage pricing theory, again, the concept was all the same, but according to Ross, the company's return is not dependent upon a single factor, that is the market. Rather, it is dependent upon several factors. And we cannot basically compute that as a composite factor of market. So each company has a different sensitivity towards the market factors. We came up with a generic formula where expected return on any company is going to be equivalent to lambda naught, which was a reflection of the risk-free rate, plus VI1, which means the sensitivity of company I to factor 1, and lambda 1, which was the factor premium. Whatever the factor was, its premium must be calculated. Similarly, for another factor, beta company's sensitivity to factor 2 into lambda 2, plus there were n number of factors, company's I sensitivity to factor n and lambda And using this particular formula, I was able to compute the return of the investments in the context of when multiple factors exist in the market, and the return is basically varying because of the sensitivity of the company to different market related factors. Now, we made certain calculations, again, certain numerical was there, and you may be required in the exam to compute the expected return using these values, or you may be required calculating the lambda using the expected return values. Another important concept which we did not cover, that was basically related to the evaluation of the portfolio performance, which probably is again one important part, but since we did not have time and the semester was adversely affected due to so many factors and ease and everything, and the lockdown and the wars, everything, and the austerity measure and everything, yet we have covered almost 85 to 90% of our course content, and which is basically a very good area of coverage. So that's about it. Thank you very much for this particular session. Despite the hindrances that we faced, yet we were able to cover for the major portion of the course. Thank you very much. And that's about it.